be it a colleague, a friend, your spouse, your siblings, anyone, just to come on board so we can increase the number, the statistic that is before us. Okay. So again, we'll start from the basics, which is investing and why the conversation is being held today. So investing comes with a long-term perspective that helps individuals achieve financial security. It also helps you retire comfortably and, more importantly, create generational wealth. And having investments also creates income streams and a safety net for the future. So when we talk about financial security, we want to ensure that you get to a point where you're financially free, and also the investments that you've created around you, or the funds that you've created around you, and the portfolio that you've built, the income that you receive from there is able to suffice when it comes to your expenses. Then you would have attained what we call financial freedom. So remember that income is not equivalent to wealth, but what you do with your income constitutes to how you build your wealth in the long term. Okay. And another item that a lot of us don't think around is retiring comfortably. So yes, we do have our national pension. We call it NAPSA in Zambia, but you also have to think around how to cushion your NAPSA savings. So we do have a lot of private retirement funds that you can look into that are being hosted either in the PIA industry or even in the capital markets industry by the fund managers. The goal here is just to ensure that when the time comes for you to retire, you would have put aside enough monies so that you don't ever have a break in income. Because the reason why we have a lot of people that are financially not financially stable in retirement is because they didn't think of what happens when their income stops coming in post-retirement. So you being a 35-year-old, a 40-year-old now, or a 20-year-old now speaks to how you need to start planning for your retirement, so that when that time comes, you would have created a cushion big enough to cater for you in retirement. And also generational wealth. So you find that nowadays, should you become a millionaire, which is my wish for everyone under the sound of my voice, you'll be first generation millionaires in your families. Yeah, we would want that for everyone here now, so that the next generation that's coming behind you, your children, your siblings, or anyone that's coming behind you, becomes second generation millionaires, or second generation wealthy families. So this is what we talk about when we talk about investments. This is what we mean when we talk about creating long-term generational wealth and investing for the long term, just so that the next generation have a cushion to start from somewhere that you left off. Okay. And also creating multiple streams of income. I know this has become a cliche now. Everyone will keep telling you, create another source of income, create another source of income. It's a cliche for a reason. It's because it's highly pertinent that you look into it and you ensure that you do have another source of income. So your primary source of income, if you have a job, should be used to create another source of income for yourself. And also we have the adage that says, don't put all your eggs in one basket. So in as much as that speaks to investing itself, it also speaks to saturating your income from one income stream. Yeah. So you need to ensure that you create multiple sources of income. Okay. And also creating a safety net for the future. So why long-term investing? First things first is wealth accumulation, which is money invested today grows significantly over time. We need to recreate the concept of planting today and reaping tomorrow. Unfortunately, in investments, that is not the case. You need to allow for time to grow your investments. And this is why when you come to the capital markets, anything that is below 5 years is considered short term. Why? Because you need to allow the fund managers, you need to allow the market, or wherever it is that you place your funds, to grow your monies. Okay, so wealth accumulation and wealth creation is wealth creation for a reason. It needs to be created over a course of time. The beauty about that is it's accompanied by a concept called compound interest. So the longer you leave your monies to grow, the more the monies grow in the long term, or the bigger your fund or your portfolio in the longer term. So you need to get into the concept of wealth creation is not a short-term venture. It's not even a short or medium-term venture. It's a medium to long-term venture. So the longer it is that you wait it out, the bigger your portfolio. And I just need every one of us to grab that concept, especially as Zambians and Africans. We want to plan today and reap tomorrow, which will never be the case in terms of an investor. This is why you need to look at some of the billionaires in the world, the likes of the Warren Buffetts, that started investing at age 11 and so on and so forth. They became millionaires in their 50s. Okay. What that shows you is you can start investing at 11, yeah. But when you allow the course of time to take its course, eventually your funds compound into bigger lump sums of funds, but you can't look at it from the short term. And also inflation protection, investing in assets that outpace inflation ensures purchasing power is preserved. On our local capital markets, we do have quite a number of products that perform above inflation. Okay, so our current inflation rate, or as of 2024, was 16.7%. So a good product should always be above inflation when it comes to your ROI, or the yield that or the range in terms of the yield that they're willing to offer. Okay. And most of our products perform above inflation. When you look at our stock market performed above 40% in 2024, making it the second performing stock market in Africa for 2024. Most of the fund managers usually aim to give you above inflation. You find that they're giving you something between 19, sometimes even as high as 22.5%. Yeah, it differs from fund to fund and the respective investment vehicles that the fund is investing into. Okay. But what that does is instead of putting your monies in a savings account, yeah, in the bank, remember there's the money markets, and also we have the capital markets. Okay. When you go into the banking sector, you will find these products, these short-term products that are fantastic for short-term objectives. But if you're looking for long-term objectives, you come into you're looking to fund long-term objectives, you come into the capital markets. You're looking to grow your monies, you're looking to invest, you come into the capital markets. And in the capital markets, you find very similar accounts, like a savings account in the capital markets. It's just that, they are called investment accounts, or a CIS account, or a unit trust account, or a fund, or they all have, very different names, but they speak to the same system, which is investing. And the fund manager exists solely for the investor. Okay, so they'll make their monies. They'll make their monies from the interest that they would have made off your funds. Okay, to put it in a layman's term. So if, let's say, they made 22% from your fund, okay, and the annual management fees are 1.5%. What they're going to do is give you the 22, or tell you they made 22.5%, then less than 1.5% charge for managing those funds for you. So you then, over the time, understand that the fund managers solely exist to make your money, then just less their management fees. And you find those activities happening in the capital markets. You find trading happening on the loose. So you want to be a part of this very robust market that not only helps you grow your money or helps you make your money in the medium to long term, but also helps you curb inflation. Okay. And participation in economic growth. Owning stocks and assets allows individuals to benefit from the economy's expansion. Okay. Every single product that you find in the capital market is directly connected to economic growth. When you look at bonds, okay, bonds is simply the government coming to the general public asking for funds. These are credit facilities to the Bank of Zambia. Okay, you're simply lending to the government of Zambia, rather, through the Bank of Zambia. Okay, so you are contributing to the projects that they have, the medium to long-term projects, short to medium to long-term projects that the government has, and you are helping them fund, and they're paying you back your money with very generous interests that are above inflation. When you go onto the capital markets, you're part of big businesses in the communities that you're a part of. Okay, you're buying stake in Zambia Sugar, you're buying stake in Shilanga Cement, you're buying stake in Zanaco, you're buying stake in all these respective companies. Okay, so you're part of something larger than yourself, and you are contributing to the economic growth of your country. And that is something that I want you to be a part of, so that we can reduce the blame game of who owns, stake in these companies. There is an invitation for you to be a part of these ownership, okay, through the stock market. Okay. And then key principles of long-term investing. One, start early. The longer you invest, the more money grows due to, again, the concept of compounding. There's a video that was playing before this session started, and the two gentlemen, one was 18 years old at the time, and they thought, investing was for someone in the later stages of I'm not yet 40, and but remember that compound interest favors the young. Yeah, the younger you are, the harder it works for you. Okay, so if you're currently 25, if you just got your first job, I would actually imploring you to start investing now. Doesn't matter how much it is, be it 500 kwacha, 1,000 kwacha. I'd like for you to start investing on the stock market, because the younger you are, the harder money works for you. I'd like you to explore the funds that exist for you. So most of the CIS of the unit trust accounts that we have in the market, taking as low as 300 kwacha, some as low as 500 kwacha on a month-by-month basis in terms of regular savings. So you want to take advantage of these experts in the fund management space that are helping you grow your funds. Yeah, you want to take advantage of our trading platform via the Luce to help you, accumulate wealth in the long term. But you want to start now. So the best time to start was yesterday, but the next best time to start is now. And I always like to make this reference point. It's growing, the gap is growing bigger by the day. But if you think you have a lot of time, you also have another thing coming. Yeah. When you look at, how far 2010 was, it still feels like yesterday, but 2010 was 15 years ago. So had you started investing in 2010, you would have made generous amounts of money 15 years later, which is today. So again, the next best time to start is today. Okay. And also investing regularly, make consistent contributions even during market fluctuations. So one of the hardest things to do as an investor is to be consistent. Yeah. And I deliberately use the word hard for a reason. If it were easy, everyone would be doing it. Investing is hard. Okay. Especially because we have we are drawn to this concept of hand to mouth. I don't have enough. So what am I putting aside, and so on and so forth. So I just need you to make sure that when you get started in this journey, you commit to yourself that this is something that you want to do for the long term. You're consistent and you follow through your own plan. And this is why objective setting is very pertinent. Yeah. It's one thing to invest. It's another thing to invest amiss. Yeah. So you want to set objectives as to why you're putting aside this money, why you're investing for the long term. We have different types of objectives. Others invest for, retirement. Maybe I want to retire early, or I want to have X amount of money by the time I retire. Others are investing for their children's education. Others are investing to further their own education. Others are investing simply for wealth creation. So there are different types of objectives. But if you have an objective and side by side, you set a target, an amount, yeah, to achieve by X time, and you set a time horizon to achieve that particular objective or goal, it becomes much easier to stay the course, yeah, because you have an objective and you want to stay true to it. So consistency is what is highly pertinent in getting started on your investment journey. and also diversifying your portfolio, spreading investments across different asset classes to manage risk. Okay, so you want to be very careful not to saturate all your monies in one particular asset. So you go into the bond market, for instance. So the bond market it's considered low risk. Yeah, I would deliberately not say risk free, because in investments we never use the term risk free. The bond market has a very low risk. Yeah, so a lot of us might want to saturate all of our funds or our portfolio in the bond market. Yeah, so in as much as it's a low risk asset or investment vehicle, it is still not recommended to put all your monies in bonds. Okay, God forbid something happened, and I think this happened in Eastern Africa a couple of years back, yeah, where the government delayed and somewhat defaulted on a bond on bonds, yeah, and there was a whole process around it. Okay, so in as much as we have the full faith of the government behind your bond placement, yeah, I just need you to know that there's nothing like risk-free in investments. Okay, and this is why we encourage the spreading of your assets and not putting all your assets in one particular, not putting all your funds in one particular assets, but putting them in different investment vehicles. That way you spread risk around, and also not just talking about the extreme side of something horrible happening, but just because of how markets perform. Okay, so maybe the stock market might have not performed really well that particular year, or your stocks might not have performed really well that particular year. Yeah, you matching it or having some form of fixed income on your portfolio will help almost neutralize your interest. Yeah, I'll use neutralize. Yeah, your losses. Why? Because you have this part, or you have this particular asset that that helped the loss on this other side. Okay, so others use it for hedging. Others, it's just a whole it's a whole way of ensuring that you don't saturate your funds in one particular asset. Okay, and just diversifying your portfolio. Asset, and also assessing risk versus return. Balancing risk with expected returns ensures steady growth. Okay, we will talk a little bit about risk and return and everything that's concerning it. And also stay informed market trends, economic shifts, and company performance and impact investments. So we have seen there are a lot of market trends and economic shifts, particularly in Zambia, yeah, where you find that one variable, especially when we're looking at macroeconomic indicators, one variable will affect another item. Yeah? So why is like the MPR, going up? What is it affecting? What does inflation affect? If inflation goes up, what are they trying to do? If FX is performing this way, okay, what is happening? Which one of these other macroeconomic indicators is being affected by this particular variable? So you want to engage. What is happening to the bond market? Why are the interests dropping? Okay, what is on the other side of interest dropping? What are the upsides of that? Of course, no one wants low interest, but then what is really happening? So you want to get a hold of what's happening and the economic shifts that are around it. Okay, and what are the trends? What have the trends been the past 5 years? What have the trends been, the past 3 years or the past 7 years? Okay, in as much as past performance does not indicate future performance, you just want to get an idea of what has been happening in either the financial institution you're about to invest in, or just the market or the industry that you're looking to get into. Okay, so you want to pay attention in what's going on according to market trends, and also company performance impact investments. Okay, so especially if you're looking to invest on the stock market, you want to assess how that particular company has performed. You want to look at their financials. You want to look at certain ratios under that. There are certain key items like who is their CEO, who's their board membership, what is it who is it comprising of? Okay, so all those items or all those variables affect how a company performs and the decisions that they make. Okay, if you're looking at a fund manager, for instance, the fund manager is qualified. Okay, how long have they been on the market? You look at certain key items that help you sleep well at night. Okay, so you just don't put your monies into a business or give it to someone to invest for you, minus knowing certain key items that would then affect you or make you lose sleep. So those are some of the key items you don't want to miss out on as a knowledgeable investor. And also patience and discipline. Avoid panic selling and emotional decision making during market downturns. Okay, so especially on the stock market, you find this a lot. You'll find a company just tanks, like shares just tank from nowhere. Maybe it's market sentiments, maybe there's something that didn't go right at some point, or anything has affected the price, the share of the price is going down. What you need to understand is sometimes, and I'll say this very carefully, sometimes it's just paper losses. Okay, you want to wait it out, and this is why, like, particularly the stock market is a high risk market. It's a high risk investment, and it's encouraged for people that want to do it long term, unless maybe you're going in it for another reason, like income, and you're looking at other items like dividend yield but if you're looking at capital gains, for instance, you have to wait it out. Okay, of course, that has to go side by side with looking at market trends and economic shifts and seeing if you want to sell off some shares from this particular company to buy into this. And now everyone is going green, everyone is talking energy. So you find a lot of people maybe buying this particular stock, maybe they're buying CEC because of them launching, all these solar projects. And so you want to keep up with what's going on. Okay, but more importantly, you want to practice discipline, and you also want to be a bit more patient. So in as much as you're hearing a lot of news coming out now, we have a lot of economists, social media economists that share so much information. It's a given that you find yourself very overwhelmed. So in the heat of all this information, you want to remain calm, and you want to be a bit more patient until you combine the facts. Okay, what is really happening here? And I would advise for you to speak to a licensed investment advisor so that they can explain to you what really is going on in the market. That way you can sleep well at night. My ethos as an individual or as an investment advisor is to ensure that wherever you place your monies, whatever you do with your money, you should be able to drive home and sleep well at night. So if you know you're not going to sleep well at night after you make that investment, please put your money back in your bank account, think through it, take some time out, think through it up until you know and you're sure that you will sleep well at night. Okay. So when it comes to risk and return, just a quick one on this. So this risk and return, there's a relationship between earning and taking up risk. Okay, a lot of us have probably heard of the saying, the higher the risk, the higher the return. Okay, but sometimes just because you choose to uptake more risk doesn't mean you get higher returns. Sometimes that means you're burning your principal altogether. Okay. So when it comes to risk and return, it's just understanding the investment you're about to get into. Okay. A lot of us have the appetite to earn a lot, but we don't have the mental fortitude for loss. Okay. We don't have the backbone for loss. That is what differentiates us from gamblers. A gambler has the appetite to gain, but they also have the backbone for loss. Okay, if you gave a gambler 100K right now, they'll walk into a casino, put it on the table in attempt to earn 100% in the next 5, 10, 15 minutes. Okay, so, and they're very much aware that this is a 50-50 chance. Okay, but in that moment, because it's a 50-50 chance, chances are they'll earn an extra 100K in the next 15 minutes and walk away with 200,000, or they'll lose the entire 100,000 altogether and walk away with zero. The only difference between a gambler and yourselves and myself is a gambler will go home and sleep well, knowing that it was just a bad day at the office. Okay, so them losing significant amounts of money stems from the fact that they understand that if I want to earn a lot of money, I should be able to lose my money. I should know that I'm going to lose my money, and that's also a given. Yeah. But where we are now, the majority of us are medium risk takers. We're not high risk takers. So you can't have the appetite of the gambler without having the backbone of one. We don't have the mental fortitude for loss. And this is why we need to come down the risk scale and settle somewhere in the middle so that we allow ourselves to earn a bit of interest, yes, whilst exposing our monies to a bit of risk. Because remember, for you to earn, you actually need to expose your monies to a bit of risk. And this is why investment vehicles or the assets, or let's put it as investment vehicles, yeah, exist in a way that they exist. Yes, we've got bonds. Bonds are low risk. Why? Because of the qualities that a bond, excuse me, possesses. Okay, it's backed by the full faith of the government, but it does have some form of risk to it. There are market risks there. Other people will call it even political risks or anything like that. In as much as we know that they're really not influenced by politics, there's a bit of it. There's a bit of risk attached to it, political risk attached to it, or market risk that's attached to it. Okay, so you want to look at what are some of the risks that are attached to this particular investment vehicle. What are the risks attached to equities? What are the risks attached to unit trust investing? So what are the risks attached to private equity? All these investments come with some form of risk. So if I'm going to earn X amount of money, if I'm going to earn 20%, that means I'm exposing my monies to some form of risk, or a risk equivalent to a return equivalent to my risk. So there are a lot of schools of thoughts around the percentage of risk. Is it 20% earning and 20% of risk that I'm taking up? It's just for you to understand that if you want to earn, know that you are risking your money. It's just how much exposure of risk are you looking to expose your monies to, and that will reflect in your returns. I hope that makes some form of sense. Okay. So some investment vehicles that we can quickly just go through. I know we're slowly running out of time. One, like I mentioned earlier, we have government bonds. So government bonds are lending instrument, like I mentioned earlier. So this is you simply lending monies to the government of Zambia through the central bank, which is Bank of Zambia. They're fixed income investment in the sense that what you agree upon when investing is exactly what you expect at the end of the tenor of the investment or at maturity. Okay, so there's a fixed interest given to you right at onset of the contract or of the investment, and that's exactly what you expect to get over the course of time. Now, because we have coupons, it's mostly coupon investing, and we don't have an interest at end of maturity. So if it's 10%, so if it's 20% now, if it's 21% per annum, if that is what was agreed upon at the beginning, it stays the same throughout the life of the bond. Medium to long-term investments, medium to long-term investing rather. So we have 2, 3, 5, 7, 10, and 15-year bonds. Okay. So of course, anything that is below 12 months is considered short term, and anything that is 2 years to 5 years is around medium term investing, and anything above 5 years is considered medium to long term investing. Okay. And then it's income generating. So income generating, it's in the sense of the coupons that you are earning every 6 months. Okay, so a bond pays you coupons every 6 months. Capital preservation. Capital preservation is in the sense that a bond is converted into a financial asset. So if you had 1 million, it's not 1 million cash. Okay, it's a 1 million kwacha bond. So you're converting your cash into an asset. Okay. It's a low risk investment, like I alluded to earlier. Minimal capital in the sense that you can purchase a bond for as low as 1,000 kwacha. Okay, so the minimum is 1,000 kwacha, and also, some things to note is there's income tax of 15% on your earnings. So they don't charge you tax on your principal at maturity. They charge you tax on your earnings or on your coupon. So there's 15% in that. And there's also a 1% handling fee by Bank of Zambia. So the total deduction is 16%. Okay. So this is an invitation. This is just to show you how a bond invitation looks like. This one was from the week before last, February 13th. So a lot of us have seen this before. What is it? It's simply an invitation, okay, to anyone out there that wants to lend money to the government. Remember, it's a lending instrument. Okay, you can lend you can lend for 2 years, 3 years, 5, 7, 10, and 15 years. And the beauty about this particular investment is part of the reason why it's low risk is all the information is given to you in black and white and in very simplified terms. All the information that you need is right there in front of you. Things like the maturity dates are there. Exactly which day in particular you expected to get back your principal. Okay. Which days exactly you expected to get your coupons. Okay. So the only reason why they will not pay you on those particular days is if it were a weekend or a public holiday, and they would pay you on the next business day. And they tell you all of these items on the invitation. There's a second page on the invitation. So you don't have to wonder. There's no in between. Everything is told to you plainly in black and white. And this is part of the reason why this particular investment vehicle is considered low risk. When you find a lot of, a lot of information that's missing in an investment, that also serves as a red flag. Okay, a good investment should be able to tell you everything plainly and in black and white. And these are bond auction results. Okay, so results are usually out the following Monday. So a bond auction will be held on a Thursday or a Friday, and results will be out the following Monday. And they'll just tell you how much it is that people bid. Remember, this is an auction, how much people bid, how much was allocated, and what the yield rate was that has been allocated to the respective years. Something I want to draw your attention to is in the first column here, you find tenure, which speaks to years from 2 to 15 years. And on the cutoff yield rate, you then see, if you correlate them to the tenure, you see that it increases as the years increase. Okay, so 2 years you have 16.2%, 5 years you have 20.25%, 15 years you have 22.8%. What that tells you is, again, in investments, the longer the tenure, the more money you're likely to make. Why? Because you're allowing the respective institution to make money for you. So they'll always appreciate a longer tenure. Okay, so that's just one thing to keep in mind. How do you purchase a bond? You can purchase a bond very easily now. All you need to do is type in BOZ CSD account onto your search engine, and the link will pop up. It should be like the first or the second link. Just open that link, and it's a very simplified process. Okay, it will either ask you to log in or create an account. If you start that process at like 10 a.m. in the morning, by the end of that particular day, or latest by the following day, your account would have been opened. Okay, all they'll ask of you is to fill in that information. The only documentation you need to open a CSD account is a certified copy of your ID. Okay, an NRC if you're Zambian, and a passport if you are not a Zambian. If you're opening for an institution, of course, there are a few more items that you need to look into, maybe like 2, 3 other documents, but it's very simplified, very, very simplified. So all you need is a certified copy of your ID. You upload it. I think there's also a part for you to upload your signature, and that's it. And your account is opened. It's an under 24-hour process. And buying of bonds now is online, so you can do that on your own. If not, you can also go through your local commercial bank and ask them to help you facilitate that process. Okay, if you need help with facilitation, that's something that an investment advisor can assist with. But now everything has been simplified through the CSD system. Okay, that's all on bonds. And on unit trusts, so unit trusts are simply a fund pooling system. Okay, so what happens is, and a lot of us have seen fund pooling from a negative point of view, but this has been in existence for a very long time and it works fantastic, especially for people that have very low capital or you're building your wealth slowly. Okay, so this is a fund pooling system. Unit trusts are licensed by the Securities and Exchange Commission of Zambia. They are supposed to be licensed by the SEC. How do unit trusts work? So unit trusts are synonymous to words like mutual funds or a CIS and they all operate the same. They are managed by a fund manager. So each particular fund in a unit trust or a CIS is managed by a fund manager. Okay, these are people that are experienced. These are people that they have the expertise to manage these respective funds. Okay, and they'll give you fact sheets that speak to the particular fund you're about to invest in. Okay, so you find different types of funds available to you on the market. You find equity-based funds, fixed income funds, balanced funds, offshore, equity funds. So even from the name, you're able to derive where the destination of your funds are. So if it's an equity fund, chances are they're investing your funds in equities, which are stocks. If it's a fixed income fund, they're investing in fixed income investments, which are your bonds or your government bonds or your corporate bonds and, fixed deposits or anything like that. Yeah. The beauty about going into a unit trust or opening a unit trust account is you are getting the same type of investments. You're getting into the same type of investments you would if you were to do it on your own, like buying a bond. You can buy a bond on your own, or you can invest in a fixed income unit trust. Okay, the only difference is you have an expert on the other side that is experienced, that understands market trends, that understand economic shifts that we spoke to earlier, market turbulences, to rebalance the fund every so often, okay, to ensure that you always at least get some form of comfortable returns. Okay, I won't speak to would you get a high return or how much you'll get in particular. We never speak to those items, but what I just need you to rest in is knowing that these funds are managed by experts, okay, that understand fund management, that understand asset allocation, that understand investing on another level. And that's something that you want to take advantage of, okay? So you will not be charged a fixed amount for the accounts that you open with a unit trust or a CIS or a fund manager. Okay, you're charged what is called an annual management fee, which is usually in percentage form. Again, I implore you to do some shopping around. We have different types of fund managers. They come with different qualities. Pick one that suits you best, that feels best to you. Okay, part of the ways of shopping around is annual management fees. There's some that are as low as 1.5 on the market. There's some that are as high as 3 to 3.5% on the market. So others charge relatively lower, others charge relatively higher. Okay, but you can't view them on that price alone. You want to look at other items. How long have they been in the business? What is the assets under management? Okay, what are they situated on? Is it retail investors? Is it corporate investors? Anything that you feel resonates with you as an investor. Okay, so do some shopping around and you'll find all the licensed unit trusts or fund managers on the SEC website. I think under dealer's license, you can look them up. Okay, so compound interest is a game changer and the world's eighth wonder. So unit trusts, bonds, stocks, they all work with compound interest. The goal is for you to keep reinvesting. And again, think long-term, patience, and consistency. Okay. The last investment vehicle we're looking at is stocks and shares. So stocks and shares is simply you having ownership in a publicly traded company. So remember there's PE, which is private equity, and we also have, publicly traded companies, and that's where we usually derive the stocks and shares from. How do you make money on the stock market? You make money two ways. There's capital gains or capital appreciation, which is the difference from the value, the difference in gains from the time of purchase to the current value of that particular stock. Another way to make money is via dividends. So these are payments made to shareholders after a company has declared a profit. So something to learn about dividends is they're not just because the stock is listed doesn't mean it's mandatory for them to pay you dividends. You need to look out for what we call a dividend policy. Okay, does that particular company have a dividend policy in place? And you also want to look at the dividend yield over the past couple of years. Okay, what was the dividend yield in 2023, 2022, and again, data collection. Of course, past performance does not speak to future performance, but it gives you context. And in investments, context is everything. Okay, so not all listed companies pay dividends, and that's something that you need to be aware of. Okay, part of the reason, or the major reason, and I'll tell you, why people invest in the stock market is for capital gains. Okay, but if you're looking for income, then go for companies or research on companies that pay out dividends and what their dividend policy looks like. Coming down to Zambia, we have the LUSE, which is the Lusaka Securities Exchange. So the LUSE was founded in 1994. It's a 31-year-old market. It's relatively young as compared to other stock markets that go as far back as the late 1800s and the early 1900s. Okay. But for us, we have a very robust stock market. It was named best performing stock market in Africa 2021 and 2022. And last year it came out in the top 2 as a second top performing stock market in Africa. So you're working with a very robust stock market. We have 20 listed companies, 8 registered brokers that help you facilitate your stock purchase. And it has averaged around 20 to 24% per annum in the past 5 years. And last year's growth rate, or ROI, was 43%. Okay. So we have different types of listed companies on the stock market. We have different industries, let's put it that way. So we have the manufacturing industry, manufacturing and oil, energy, mining and investments, banking, insurance and finance, agriculture and processing, property, retail, mobile, and hospitality. Okay. You can pick a stock based on, different variables. Okay. Other people just pick, out of emotion. I shop in ShopRite, so I'll buy ShopRite shares. Okay. My children wear butter shoes. Sorry, Stali, are you trying to say something?
Yes. We are out of time. We need to get into our Q&A session. So I'd ask you to just wrap up.
Okay, great. Okay. We'll be concluding now. Okay. So when picking a share, like mentioned, you need to speak to things like, am I buying a share because of capital appreciation or dividends? And when it comes to picking or making your stock portfolio, you can pick based on emotions, which we really don't recommend, but also there are a lot of variables around stock picking. Or you can look at past performance. Okay, you can look at dividend policies. You can also look at management of that particular company. Okay, you can look at their ESG practices. Do you relate with them? There are a lot of variables as to why people invest in Zanaco. It's a Zambian bank. I would rather invest in Zanaco than invest in Standard Chartered. Other people would rather invest in Standard Chartered because it's an international bank. And I invest in Airtel. Yeah, I'm investing in Airtel because of this particular reason. I'm investing in Puma because at some point I thought I would own, a filling station. Let's put it that way. I wanted to go into the energy sector at some point, but then I don't think that is working. So I would rather invest in Puma. All these reasons, okay. But more importantly, please sit down with an investment advisor that will help you come up with a stock portfolio that reflects you as an individual. Okay, and just to summarize, again, portfolio and asset allocation also goes with age. So remember, the younger you are, the more time you have to be a bit more aggressive and also expose your monies to a bit of risk. But remember, it needs to sit well with your risk appetite and also going hand in hand with your objectives. Middle age between 40 and 50, you are now in a balanced growth and stability stage. So you need to be very moderate. You need to go for moderate risky investments for stable growth. Okay. And then anyone 60s and beyond, or 55 and beyond, it's more capital preservation and low risk investing. Okay. So this just speaks to how in your 20s and 30s, you're looking for you have a bit more high risk tolerance, and your primary goal is capital appreciation and aggressive wealth accumulation. Middle 40s to 50s, you are looking on reducing your exposure to market volatility, and you're looking more for balancing your portfolio. And elderly, it's mostly and always will be capital preservation to secure retirement income and reduce exposure to market risk. So it's your risk appetite reduces the older you grow. So our key takeaways today is: one, start investing now. I implore every one of us to become an asset lover. I think from the video that was shared earlier, look at purchasing appreciating assets as compared to purchasing depreciating assets. Stay disciplined and consistent. If you start today saying, I'm going to be investing 1,000 kwacha every month, and you recognize or you narrow down which investment vehicles you want to be investing in, I need you to stay the course. Yes, and also look at rebalancing your portfolio as years go, as market trends change, and okay. So my name is Lyapa, coming in from Money Acumen Advisory, and on behalf of the Capital Markets Association of Zambia, thank you so much for having me. Now taking some questions.
Okay. Thank you so much, Lyapa, for that very elaborate presentation. I hope everybody has learned one or two things. I know I have. Okay, we'll get straight into the questions because we've exhausted the hour for the meeting, but we can take at least 5 questions or so. So we'll start with Dixon Kunda. He's got a question saying, how can someone know if a particular stock item is above the inflation rate so that they best determine their ROI and see if it's a profitable investment or not? What information can they be looking out for on the stock market in relation to that? Okay, Lyapa, did you get that one?
Should we go question by question?
Or, okay, maybe let me get another one so that it's a bit quicker, yeah?
Yes.
So what is the best way to put money in a fixed deposit account? What is better, to put money in a fixed deposit account or in securities? Then the other one says, when it comes to investing in government bonds, is there a limit to how many bonds one can buy? Or can one buy bonds every month, like a 15-year for 15 years? Okay, maybe the 3.
Okay. Okay. I'll start with the last one. How many bonds can you buy? You generally don't have a limit. I don't think there ever has been a limit on how many bonds you can buy. So we call that laddering. So if you don't, instead of investing, let's say 1 million, for example, once off and just getting 2 coupons, you can invest. You can buy 6 bonds and get an income every month. Okay, because remember, for each bond you're getting 2 coupons. So if you buy 6 bonds, you're getting 12 coupons. Okay, so that means every single month you'll be getting a coupon. So yes, you can buy a coupon you can buy a bond every single month, looking at your objective. Is it income every month? Is it income every quarter? We call that laddering. So you can ladder as many bonds as you wish. Okay, I hope that answers the question. The next question, which one is better, fixed deposit or securities? Okay, how do I say this delicately? So the capital markets is where institutions and retail investors go to grow their funds. Okay, so you can place your funds in a fixed deposit if it's aligning with your objective and they're offering you generous returns, okay, or if they're offering you returns that are above inflation, okay. And you can go into securities again if it aligns with your objectives. Because remember, most fixed deposits are below 12 months. It's up to 12 months. Okay, so if your objective is up to 12 months, please then go and purchase a fixed deposit. But if you are looking at a longer term objective, maybe 2 years and above, you can go into securities. Which one is best? I will not say go for securities because my bias is towards capital markets. So that will always be the answer. But I'm saying always match it with your objectives. Okay, Stali, what was the other question? Sorry.
Okay, so the other question was, how can one know if a particular stock item is above the inflation rate so that they best determine their ROI or see if it's a profitable investment or not? What information can they be looking out for on the stock market in relation to that?
Okay. For starters, the stock market usually performs above inflation, eh? I don't think we've ever had a year where the average returns are performing below inflation. But if you're looking at a particular stock itself, you're looking at their financials. So there are certain ratios that you're looking out for. One, the financial health of the business. So the financial health of the business is one, and two, the capital gain. So what's the percentage that the company gained by, like the stock price gained by from the previous year. So if you look at a company like Airtel, for instance, last year was the top performing stock. It gained by 114, about 114% capital appreciation. Okay. And you look at some other companies, for instance, I'll pick on Chilanga. So Chilanga, so there's capital appreciation, and then there's also companies that pay dividends. So Chilanga, for instance, paid around 11.8% if you're looking at their dividend yield. Okay. So the dividend yield plus the capital appreciation should be able to give you a roundup of how much you're looking at in terms of returns, overall returns, capital gains plus dividends. So one is income, one is capital gains. So there are quite a number of items to look out for, but the financials should give you a good view.
Okay, great. I hope that answers the first few questions. We'll get into another set of questions. How are we to navigate this disruptive economic? How are we to navigate in this disruptive economic environment with the advent of cryptos, which are so disruptive and already making traditional modes of investment lose popularity? That's the first question from David. Then we have another question saying, what investment options can you recommend for someone who wants to grow small funds for huge capital that can be later invested in bonds? Then the other one says, we all start small. I mean, I did bonds. Okay. Not that one. What is the process for participating in the bond market? And I think this is something that was already tackled in the presentation by Lyapa. Then, since we're discussing long-term investments, are there any other asset classes apart from bonds, CISs, and equity? So maybe you can take those two, the three.
Okay. So cryptocurrency and other investments losing relevance. Yes, cryptocurrency has been disruptive. That's correct. But then again, like I mentioned, it all goes with risk appetite. Yes. So all investments will always be relevant. Why? Because different individuals have different risk appetites or different risk profiles. So for individuals that risk takers or they have a higher risk appetite, cryptocurrency will always be attractive to them. Okay. But let's not disregard the majority that are medium risk takers and others that are low risk takers. So it just depends on which in which demographic you fall into. Okay. Is it disruptive? It has been disruptive, but again, risk appetite will always guide which investment vehicle to go into. So none of the other investment vehicles are irrelevant at all. Okay, it's just a matter of preference. Small fund recommendation. I don't want to go into financial advice, but like I mentioned, I've mentioned
Please.
different. Pardon?
No, you're very right. We will not dive into financial advisory at this point.
We can't do financial advice, okay? So again, start out small, like we mentioned, that the different types of investment vehicles that I've mentioned. Feel free to, open a CIS account, put some monies in there, let it grow, and you can always transition. But please speak to your financial advisor so that they can give you specs according to your risk appetite and your objectives and everything around your profile. Long-term investments, apart from the traditional investments. So part of the reason why I mentioned those in particular is those are the ones that are licensed by the SEC, or they play within the regulatory space. I wouldn't want to mention others that are not regulated. They do exist and they're there in numbers. Things like businesses, things like private equity, and so those again speak to the investor profile of the individual. So if you're looking for anything other than the traditional investment vehicles that we've spoken to, please feel free, but remember that you're now doing it outside the regulatory space, and now you're almost exposing your monies to a bit more risk or higher risk. So yes, to answer your question, yes, there are other investments that exist away from the traditional investments that we've spoken to, but those you have to enter in sober-minded, knowing that the risks that exist and you can't run back to the regulator for them to protect you.
Okay, thank you so much, Lyapa, for that. Just thought I also emphasize the fact that the town hall meeting is meant for education purposes only. We do not give investment advice on this platform. So the information you're receiving today is strictly for educational purposes. If you'd like further information, specific let's say strategies on how to get into this investment and whatnot, you can then contact our licensed investment advisors and brokers to give you that information. And then again, that's why the Commission has partnered with the Capital Markets Association of Zambia, because they represent the market that can offer you that information through dealing with professionals in the market. Okay, I just thought I mentioned that. Then we have another question. This is from Moses Chileshe saying, what role does SEC play in regulating the dividends? Because I have observed some companies don't pay dividends consistently. And then his question is in two parts. The second part says, the looser market moves at a very slow rate. What measures has SEC put into place to address this problem? I'll have somebody from SEC take this. Maybe Leah, if you're on the call, kindly assist. I'll ask our IT team to just elevate the SEC team to panelists so I can speak. Okay. I'm told Leah is not on the call. Any other person? Mr. Bruce, are you here with us?
I said yes.
Okay. So we have a question saying, what role does SEC play in regulating the dividend? I think this is in relation to dividend policies, because Lyapa did mention that dividends being paid out when you invest in equities.
I said
Can you get me?
yes, I can.
Yes, I was saying we have a question regarding the dividends.
Yes.
Okay. Please go ahead.
The SEC does not regulate how companies pay dividend. They present you rightly put it that each company has a dividend policy. So the company will pay a dividend based on their dividend policy if they have a policy at all. So the short answer to that is that no, we don't regulate whether companies should pay a dividend. That would depend on a recommendation by the management whether a dividend should be paid or not. So we don't actually regulate that. Thank you.
Okay, thank you, Mr. B. Okay, so there's a second part to this question. The question says the Luce market moves at a very slow rate. What measures has SEC put into place to address this problem? I do know we recently had a presentation actually around this, where we mentioned to the public that coming to market is a business decision to be made by an institution. So what incentives maybe Mr. Bish can speak to the incentives that the Commission has put into place to try and address the slow rate at which maybe we have listings or increase of companies on the Luce.
Stanley, as you mentioned, rightly mentioned, in terms of in the number of listed companies, it's a business decision that a company has to make whether they want to list. If they see the benefit of using the capital markets, they'll register their securities and have them listed. So on that front, we can't do much because the potential issuers need to see the benefit of being listed. In terms of what the Commission is doing, in terms of incentives, there are some incentives which are there for the investor and for the issuers. I think there's a low tax rate that the issuers pay. And in terms of the investors, there are benefits like there's no capital gains tax. So when your shares appreciate, that increase in value, you won't be taxed. There's no property transfer tax. When you sell shares, no taxes are payable. So those are some of the incentives which are in place for the investors.
Okay, thank you for that. Unfortunately, we have exhausted our time today. It was a very interesting topic, and I know a lot of people had a lot of questions from my inbox here. I can see a lot of questions. So what we'll do, we'll continue. We'll have we'll take about 5 more questions, but seeing as we had put a time for up to 16, we can officially close the meeting and thank everybody for joining. But our presenter will stay on and attend to the next 5 or so questions, just so that we keep it as interactive as possible. But please feel free to leave and join us for the next town hall, which is on the last Thursday of next month, the month of March. Okay, so I'll take another question. I'll read another question. What does it take for one to be a member of the Capital Markets Association? How can I qualify to be a financial literacy participant, as I have interest in educating fellow friends and the general public in order for them to become financially literate? Okay. So I'll attempt this first part of the question. To be a member of the Capital Markets Association, you need to be, okay, no, I'll leave that one for Lyapa. You can speak to CMAS. But then to qualify for a financial literacy participant, as you have a passion to educate people, I'll speak to the Capital Markets Ambassador program that we have at the Commission. So we do have a program for to be a Capital Markets Ambassador, where we have trained, we opened up to the public and trained a number of members from the public coming from the different provinces of the country, or 10 provinces. That way we train you and you become an ambassador to speak on capital markets and to take part in the different programs that we have. So, but then that does not stop you from still participating in the different financial literacy programs that we have. Feel free to reach out to us and we can see how best we can work with you. Lyapa, you can take the other part.
Okay. So joining the Capital Markets Association is relatively easy. It's very easy actually. So you can just write to is it join at simaz.com. Anyway, I'll share that information with Starley, but it's a very easy process. We have 3 or 4 different tiers. So there's one for students, there's one for clubs, then of course for professionals, and one for institutions. And for students, it should be 500 kwacha. Clubs should be should also be 500 kwacha joining fee. Then 2,000 and 7,500 for professionals and institutions respectively. So it's a very easy process. It's a one-pager application form, and your certificate is given to you in 72 hours. And of course, the membership is renewable every year.
Okay, thank you so much for that. I'm pretty sure you're going to receive some applications for membership as the process is quite simple. So the other question that we have is from Daniel Zulu saying, I recently opened an account, but I can't see where to transfer money from my bank account into the CSD account. And I'm told you haven't placed any bids yet. There's no corporate actions for the selected time frame, or is there no auction yet?
Is that for the Lusa CSD, or is it the Bank of Zambia CSD account?
It's the Bank of Zambia CSD account, because she's saying this person, Daniel, is saying that they want to see where they can transfer their money from their bank account into the CSD account. So I'm not sure, Daniel, maybe you're not very clear. You're saying I recently opened an account. Does it mean you opened a bank account or a CSD account?
No, I think he means the CSD account. I can see his question.
CSD account. Yeah.
There should be a page under his profile that speaks to him entering his bank accounts and which one should be his primary bank account for transactions. And also remember, you can't process any bids or participate in the auction if there isn't an auction that's open.
Okay.
So he
Yeah.
needs to enter those details, then wait for an invitation. So the invitations then used to be every 3rd week of the month, but there's now a calendar that's issued way ahead of time, every quarter, indicating when the auction dates are going to be. So yeah, he can find that information, or Daniel, you can find that information on the Bank of Zambia website on when the next auction date is.
Okay, sticking to bonds, there's another question from Amos Kanyemba saying, is it possible for one to change ownership of the government bond? If yes, what is the procedure?
Yes, you can change ownership on a bond, but you have to sell it. So that's the only process. You're selling it to another person. There are documents on the Bank of Zambia website. Yes, there are documents on the Bank of Zambia website, but it's a very seamless process. If you can't do it on your CSD account, I'll suggest you go to your respective bank. Sometimes banks actually buy bonds. Yeah. So you're selling it to another person.
Okay, thank you for that, Lyapa. Okay, one last question. This one comes back to the SEC. Mr. Bruce, you spoke about the dividend policy in your last response. There's a question here saying, is it mandatory for a listed company to publish their dividend policy?
I can answer
Mr.
that
Bruce,
to
are you on
Mr.
the...
Bruce. Yeah.
Okay, yeah, you can go ahead.
So is it mandatory?
Yes.
If the company is a dividend paying company, if they do have a dividend policy, they'll offer it to their investors. That's if they're a dividend paying company. So if they don't have any dividend policy in place, chances are you won't find it anywhere because they're not offering dividends. Because remember, dividends are not mandatory, yeah, in the sense that it is at the discretion of the board after a company has declared a profit. So even if they're a dividend paying company, remember, there are all these steps that need to be exhausted. Has the company declared a profit, and has the board agreed to paying out a dividend? And remember, the dividend policy will speak to all these items.
Okay. One last question, or rather two last questions. So when buying units, can you use the same account as one that you use to buy stocks? This is from Kelvin Walia. And then an anonymous attendee is asking whether, seeing as the bond rates are failing, and this is worrying to young investors like himself, is it profitable to invest in government bonds with the rising inflation rates, currently standing at 17%? Are there any remedial measures to address the dropping rates?
Okay.
You can start with the buying of units. Can one use the same account to buy units? I'm assuming this is in the collective investment scheme as well as stocks.
Okay. I'm trying to get the context of the question. So if we're talking about buying new units in a CIS or in a unit trust, can you use the same account? No. So the fund managers will always advise which bank account to deposit funds into, depending on the fund that you've selected. So if you're investing in an equity fund, chances are you'll be depositing funds that allow you to invest in an equity fund. So, and if you're investing in a fixed income fund, they'll give you a bank account that allows you to deposit funds that then find your money in a fixed income fund as the final destination. So can you use the same account? No, you can't. You can't. Different funds have different accounts, and your fund manager should help with that. The second part, which speaks to inflation and being a young investor, I think towards the end of my presentation, I spoke to the timelines and asset allocation. So if you're between the ages of 20 and 30, I wouldn't recommend you. Okay, this is not financial advice. Yeah, this is just general financial literacy. Age plays a huge role in which investments you should go into. Okay. And also your risk profile comes in second to that. Okay, let me not say second, but it also plays a huge role. So if you're young right now and you're looking at earning higher returns, then look at your risk profile, have a chat with an investment advisor, look at the licensed products that are available to you, then pick from there based on your risk profile. Okay. If you think bonds are not performing well for you as a young investor, you can explore the stock market. Okay. But bonds are still performing above inflation. So they're still a relatively good asset to have on your portfolio. Yeah. The benchmark will always be inflation. Yeah. I'm trying so hard not to give financial advice. The
I
line
know
is
there's a very thin line, but yeah. Okay. Lyapa, thank you so much for the presentation today and taking time to represent CIMAS and partner with SEC on this very important topic. Thank you everybody for joining us. We will see you again next month, on the last Thursday of the month, with yet another interesting topic. For more responses, we will send all the responses via email to your emails, and also for those that missed the presentation, we'll send the recording, and then we'll also, it's also on Facebook, you'll be able to see the presentation there. Thank you so much, everybody. Have a good afternoon.
A smart investor avoids fraud. And here's everything you need to know about being a smart investor. A smart investor recognizes the benefits of planning for his or her future needs and goals, such as education, marriage, buying a car, or even buying a home. A smart investor recognizes the benefits of regular and diversified investments to protect investment from losses, unexpected events, and always looks before they leap so that they can cash in on the wonderful effects of compound interest. After all, a smart investor knows every investment opportunity is unique and should match their needs, goals, and risk tolerance while making sure to ask all the right questions. A smart investor is not under pressure to make hurried investments to avoid fraud. They know the risks and stay far away from get-rich-quick schemes while ensuring the company that they wish to invest in is licensed by the Securities and Exchange Commissions. So, what do you say? Do you want to be a smart investor? All it takes is cultivating resilience and wise habits. Remember, a smart investor avoids fraud. Visit sexzambia.org.com or our social media platforms today to start your journey to being a smart investor.